pause for a moment. While everyone's been fixated on metals, memes, and market headlines, a critical shift just occurred in the darkest corner of global finance. Japan, the country that spent decades treating interest rates like they didn't exist, is suddenly paying real yields again. That might sound mundane until you realize it's equivalent to yanking the power cord out of the global economy. For years, Japan operated as the world's cheat code. Need cheap money? Go to Japan. Want to borrow at nearly zero? Go to Japan. Looking to execute the carry trade? Borrow yen, buy everything else? Japan was the fuel source. This wasn't just a Japanese phenomenon. It was the invisible engine underneath stocks, crypto, real estate, venture capital, essentially the entire everything bubble. That engine is now stalling. The numbers appear harmless without proper context. A 10-year Japanese government bond yield around the low twos. A 30-year pressing toward 4. A 40-year poking above 4. If you're in the United States, you glance at those figures and shrug. But Japan is not the United States. Japan is where investors learn to live with 0% and even negative yields. In Japan, a move like this isn't a speed bump. It's a cracked axle on the highway. Here's what most people miss. Japan isn't just another economy. Japan is the creditor country. Japan is the vault. Japan is the global savings machine that has been exporting capital for decades. When Japan earns nothing at home, its institutions hunt abroad. They buy foreign bonds, foreign stocks, US Treasuries, the safe paper keeping the global system glued together. So when Japan's home yields rise, something dangerous happens. The incentive flips. The money doesn't need to leave anymore. It can come home. And when money comes home, it doesn't tiptoe. It drags liquidity out of everything it touches. Picture global markets as a giant pool. For years, Japan was pouring water into that pool. Now the hose is turned off and the drain is open. You don't notice at first. The water level just drops a little. Then the shallow end gets weird. Then the deep end starts exposing what was hiding underneath. Finally, people realize the pool isn't low. It's emptying. This is why the bond market matters more than silver, more than Bitcoin, more than whatever trend is loud right now. Because the bond market is the funding market. The bond market is the price of money. And when the price of money rises in the wrong place, at the wrong time, with the wrong debt load, you don't get volatility. You get forced selling. Japan's debt burden is massive. When you carry that kind of debt, you can't tolerate higher rates the way a normal country can. Higher yields don't just hurt. They eat budgets, devour tax revenue, turn governments into debt service machines. That's why Japan spent years doing the unthinkable. The central bank buying huge amounts of its own government bonds to keep yields pinned down. It was a policy, yes, but it was also a confession. It was Japan admitting that if they let the market set the price of money, the math breaks. So what changed? The currency. For a long time, Japan could suppress yields and tolerate a weak yen. But a weak currency isn't a free lunch forever. A collapsing yen makes imports more expensive, energy more expensive, food more expensive. Eventually, a country faces the impossible choice: protect the bond market or protect the currency. Japan is being forced toward reality. And reality in a debt-heavy system looks like this: bond prices down, yields up, and balance sheets that suddenly don't add up. Now let's discuss why this reaches into your life, even if you've never owned a Japanese bond. Because Japan's institutions have been holding a gigantic stack of foreign assets. US government debt, US equities, the same mega-cap stocks sitting inside your retirement account, the same indexes everyone feels safe owning. Here's the pivot. If Japanese institutions can earn a meaningful yield at home in their own currency without foreign exchange headaches, the reason to keep foreign exposure shrinks. And if they also have losses at home from falling bond prices, the pressure to raise cash grows. That's repatriation. And repatriation isn't a vibe, it's a flow. It's money moving in size. Let me make this crystal clear. When yields rise, bond prices fall. Japanese funds holding piles of domestic bonds see their safe holdings lose value. That creates holes in balance sheets. When you have holes, you patch them. And the easiest patch is to sell what's liquid and what has gains. Often that's foreign equities. Often that's US tech. Often that's the same crowded trade every global investor has been swimming in. So the risk isn't that Japan's economy slows. The risk is that Japanese capital exits global assets. And when a big holder becomes a seller, markets don't care about your feelings. Markets care about supply and demand. Here's where the story gets nasty, because it doesn't stop at stocks. There's a second bomb: the carry trade. For years, borrowing in yen was basically free. Funds borrowed yen, swapped into dollars, and bought higher yielding assets: stocks, high yield credit, emerging markets, crypto, real estate, anything that looked like it could outrun a near zero funding cost. But when Japanese yields rise and the yen strengthens, that trade gets squeezed. And a squeezed trade has one universal outcome: liquidation. They don't unwind because they want to. They unwind because margin forces them to. That's why you can have a day where nothing new happens in the news, and yet markets drop in a way that feels irrational. It's not irrational. It's plumbing. It's a funding unwind. It's leverage getting reversed. And the worst part? This unwind is self-reinforcing. Here's how the loop works. Japan's yields rise, signaling tighter conditions in yen funding. Positions funded with cheap yen become less profitable or outright dangerous. Funds reduce risk and sell assets bought with that funding. The selling causes prices to drop, which triggers more margin calls. More margin calls mean more selling. The loop feeds itself. Now you see why this matters to everything, because it's not a single market story. It's the story of global liquidity reversing. If you've been investing for the past decade and a half, you've lived in a world where liquidity kept bailing everyone out. A dip happened, the printer appeared, a crisis showed up, rates got cut. But what happens when the crack is in the place that was supplying the cheap funding? That's Japan. This is why some people call Japanese bond turmoil the widowmaker. For years, traders tried to short Japanese bonds or bet on rising yields. And for years, they got destroyed because the central bank kept buying. But here's the twist. The train is running out of track. The currency constraint is tightening, and the market is starting to call the bluff. So where does this go? There are three paths. Path 1. Japan tries to recap the bond market by massive buying again. That stabilizes yields, but risks crushing the yen further. Path 2. Japan lets yields rise and accepts pain in the bond market. Path 3. Some messy hybrid. Interventions, policy tweaks, but still a slow drift toward higher yields. No matter which path they choose, global markets are not returning to the easy money environment. That chapter is closing. Now let's connect it to the United States. Japan is one of the largest foreign holders of US Treasuries. If Japan reduces buying, US debt auctions get harder. If Japan actively sells, US yields rise. And when US yields rise, everything that depends on cheap financing starts to wobble: housing, auto loans, corporate debt, regional banks. That's why the Japanese situation can be a trigger for US financial stress, even if the US economy looks fine right now. Because yields don't care about vibes. Yields care about buyers. Think about this. If one of the biggest buyers steps away, who replaces them? That's the Fed's nightmare. Because in a world where deficits are large and debt issuance is relentless, the bond market needs constant demand. If foreign demand weakens, there's one buyer left with infinite capacity: the central bank. And when the central bank becomes the buyer of last resort again, you don't just stabilize the bond market, you debase the currency. That's the trade-off. So if Japan's crisis leads to a scenario where the Federal Reserve must support the Treasury market more aggressively, that's the bridge back to hard assets. That's why people run to things that can't be printed. And yes, that includes silver and gold. The scary part isn't that this could cause a crash. The scary part is that it could create a long, grinding regime change. A market where rallies get sold and dips don't rebound the way people are trained to expect. This matters because most retail investors are conditioned to one strategy: buy the dip. But buy the dip works when liquidity is rising. When liquidity is falling, dips are traps. And Japan is a liquidity story. Let's talk about forced selling in its ugliest form: structured liquidation. When a large institution needs to adjust its portfolio, it doesn't slam a market order. It sells into strength. It uses rallies as exits. It spreads the selling over weeks, months, sometimes years. So you might not get a single dramatic day where everything collapses. You might get a market that feels heavy, where every rally stalls, where everyone is confused because the news is positive but prices keep fading. That's a distribution regime. And in distribution regimes, the biggest danger is psychological. People keep thinking this is the bottom. They average down. They get chopped up. Meanwhile, the real seller is calmly unloading. Now let's layer in the currency effect. When Japanese institutions sell foreign assets, they often convert proceeds back into yen. That means they sell dollars and buy yen. That pushes yen higher. And when yen rises, the carry trade gets squeezed harder. So the act of repatriation itself can tighten global financial conditions further. The unwind accelerates itself. This is why Japan pulling the plug isn't a metaphor. It's describing a withdrawal of cheap funding that the global system quietly depended on. You might be thinking, does this really hit mainstream investors? It starts as a hedge fund problem. It ends as everyone's problem, because hedge funds sell into public markets. They sell what you own. They sell what's liquid, and the ripple spreads. If you've ever wondered why a sell-off can hit stocks, crypto, and credit at the same time, it's because they share the same funding source. The story isn't Japan is doomed. The story is the system, the global architecture built on leverage and low rates, with Japan as a core pillar. When a pillar shifts, the building creaks. So what should you do? First, stop treating this like entertainment. This is a structural change. Second, start watching the right indicators. Japanese yields, yen strength, US Treasury auction demand. Third, prepare a plan, not a panic. The US Treasury market is the foundation. It's the collateral. It's the benchmark. If foreign demand weakens, the US has two choices: pay higher yields to attract buyers, or have the central bank absorb supply. Higher yields mean pain. Central bank absorption means debasement. Here's the simple truth. When a system has too much debt, it cannot tolerate high rates. When rates rise anyway, something breaks. When something breaks, policymakers choose between default and printing. Most of the time, they print. And printing doesn't feel dramatic on day one. It feels dramatic when prices reprice. This is where hard assets come back into the story, not because they're magical, but because they're outside the promise-based system. If you're holding a portfolio built on the assumption of permanently low rates, you're holding a portfolio built on a regime that is ending. When Japan could earn nothing at home, global markets had a constant tailwind from Japanese capital searching for yield. If Japan can now earn at home, that tailwind weakens or flips into a headwind. And headwinds show up in the grind. A slow squeeze on liquidity. A slow squeeze on valuations. The assets most exposed? Mega cap tech. The most liquid winners and easiest to sell. Speculative assets dependent on liquidity. Anything levered to low rates. Certain real estate segments. Highly indebted companies. Pockets of credit. In a world where bonds aren't safe, stocks aren't guaranteed, and cash bleeds quietly, the question becomes, what do you own that doesn't require someone else to keep a promise? Because when leverage unwinds, the biggest pain is counterparty risk. Here's a framework. Reduce exposure to long-duration risk if you don't understand it. Be careful with leverage. In a liquidity reversal, leverage is a weapon pointed at you. Consider hard assets as insurance rather than as a trade. Keep liquidity in forms you trust. This is why gold and silver re-enter the conversation, not because they guarantee profit, but because they remove certain risks. Volatility is not the same as counterparty risk. When a system freezes, the question becomes settlement and trust. Hard assets bypass parts of that. The most dangerous part might not be stocks or bonds. It might be the moment policymakers try to fix it, because the fix comes with a cost: currency debasement. That's why silver and gold can surge even as markets feel unstable. Instability produces the exact policy responses that hard assets benefit from. Markets don't move on headlines. Markets move on marginal changes in funding, liquidity, and incentives. Japan is a marginal change that isn't marginal. It's the center shifting. For decades, Japan has been the anchor of low global rates. If that anchor lifts, waves get bigger. Weak structures break. Crises don't announce themselves with a siren. They announce themselves with small, weird moves in places most people ignore. Japan is one of those places. The plug is being pulled slowly. Liquidity is draining quietly. And the people who understand this early get to choose their position. The people who understand it late get forced into a position. Keep your eyes on Tokyo, not because Tokyo is the story, but because Tokyo is the switchboard, and the switches are moving.